Welcome to Analyst's Estimate. We bridge the gap between Wall Street and Main Street by breaking down complex investment research so you don't have to. Disclaimer. This podcast is for educational analysis, not financial advice. AI powers much of our research, but AI can make mistakes and data can occasionally be inaccurate. Treat this as a business analysis rather than deep company research. Always do your own due diligence before investing. Okay, let's unpack this. Today's deep dive centers on Rossell Techsys Limited, or Rostech. They're a highly specialized player in the aerospace and defense supply chain. And this is a really interesting one to look at because they just completed a pure play demerger back in August 2024. So they've really focused their entire operation now purely on this high precision A&D manufacturing. So our mission today is to solve what looks like a big financial puzzle in the analyst's final report. We're going to dig into why this company is valued at such a significant premium, way higher than its peers, and critically why its massive revenue surge is, for now, causing a steep drop in profitability. We'll show you how that's actually a strategic choice and what critical risks, especially around working capital, you really need to understand.
What's fascinating here is that the core investment thesis, right from the executive summary, is all about scarcity. Rostech is defined as a pure-play, high-precision A&D compounder. So they've, shed their old business structure to focus only on these mission-critical components for the global aerospace giants. Their whole value proposition boils down to two areas: electrical wiring and interconnect systems, or ESSI, which is basically the nervous system of an aircraft.
The whole nervous system.
Yeah, exactly. And electronic systems and system integration, ESI, which you can think of as the brains. And these fields have, just extreme quality modes and really high switching costs. That's what justifies their current valuation of about 2,367 crore.
And it seems like the macro environment is a huge tailwind for them. Section 2 of the report points to global A&D spending hitting a record, $2.178 trillion in 2024.
A huge number.
But then you have India's Make in India initiatives on top of that, which basically push foreign OEMs to source from specialized Indian firms like Rossell. It's kind of a perfect storm for them.
It is. And if you look at their structural strength, the analyst uses Porter's 5 forces for this. The weighted competitive pressure score is incredibly low. It's a 4.8 out of 10.
So very low pressure.
Very low.
Yeah.
And that's because the barriers to entry are just immense. Let's talk about the biggest one.
Yeah.
Certifications. The threat of new entrants is rated at just 2 out of 10. And that's because you need over 45 NADCAP process certifications.
Okay, hold on. I think we need to slow down on that acronym, NADCAP. For anyone listening who's not familiar, what's the significance of having 45 of these? It sounds like a lot.
Oh, it's absolutely essential context.
Yeah.
NADCAP is the highest level of third-party auditing that exists for special processes in aerospace. Think welding, heat treating.
The really critical stuff.
The most critical stuff. Getting just one NADCAP certification is a multi-year, incredibly complex process. So having over 45, Rossell has basically built an industrial fortress. A new competitor can't just show up tomorrow. They'd have to spend a decade and hundreds of millions to even get close.
That definitely explains the low threat from new players, but how do they lock in their existing clients? That's where this operational moat comes in.
Exactly. And the moat is rated 9 out of 10, built almost entirely on high switching costs. And this isn't just theory,
Yeah.
It's physically integrated into global defense supply chains.
The report mentions their systems are integrated into 12 flagship U.S. military platforms. We're talking about the F-16, the F-18 Super Hornet, the Apache attack helicopter.
Right. So for a huge OEM like Boeing or Lockheed Martin to even think about switching suppliers for a system that's so deeply integrated, the cost of recertification, re-engineering, the risk, it's just economically prohibitive. Once you're in for the life of that platform.
Where they are effectively indispensable.
For that platform, yes. And while their core wiring business is still about 70% of revenue, the real strategic pivot is what they're doing now. They're pushing hard into space and semiconductor verticals. The projection is for that to hit 25% of revenue in FY26. They're changing their business mix right now.
Which leads us perfectly into the financial story, and this is where the puzzle really starts. Because if the moat is that strong, you'd expect just fantastic numbers. But the performance review shows a huge contradiction. So let's look at the good news first. Revenue momentum is explosive. Total income in FY 2024-25 was over 26,000 lakhs. That's a solid 19% year-over-year growth.
And even more dramatic, Q2 of FY 2025-26 saw a 145% year-over-year revenue surge. The order book is definitely converting.
And this is the big but. Despite all that growth, profit after tax actually decreased by almost 30%. The net margin fell from over 5% down to just 3%. That's a massive compression.
It is a 209 basis point drop. And the core question for any investor is, how can you grow your revenue so fast, but have your profit margin shrink even faster?
Yeah, that raises the immediate question. Is this just a failure of execution by management?
The report argues pretty firmly that it's not a failure, but a deliberate structural investment. If you trace the costs back, Level 1 shows that the cost of materials consumed jumped to over 57% of revenue. The Level 2 cause for that is the aggressive execution of new contracts in those target sectors, semiconductor and space. This requires this really intense process called first article inspections, or FAIs.
Wait, a first article inspection. What is the real-world impact of an FAI? Is this basically the company paying a huge sunk cost to prove to someone like Boeing under a microscope that they can make the first 100 units perfectly?
That is a perfect way to put it. An FAI is where you demonstrate you can produce a new, complex product exactly to the blueprint consistently. For these new space and semiconductor components, that means a steep learning curve, intense engineering oversight, higher scrap rates.
All things that kill your margins in the short term.
They absolutely crush your margins temporarily. You're taking a calculated hit on the income statement right now.
So the level 3 root cause is what the report calls the incubation cost of this strategic pivot. They're sacrificing margins now to get into these new verticals. What's the payoff? Why is that sacrifice worth it?
It's worth it because of the long-term margin potential. The legacy A&D business has good, stable margins. But the street expects the mature margins in the new semiconductor and space verticals to be 2, maybe 3 times higher once they get past this FAI stage.
I see.
So they're giving up 209 basis points now to capture what's projected to be 40% of their revenue from these high-margin sectors by FY27. It's a classic case of delaying gratification for market dominance.
But that build-up, that investment, it leads directly into the biggest risks outlined in the report, right? And they all seem to center on cash flow.
Yes. The number one risk that demands attention is the working capital intensity. The report flags a truly stunning figure, a 607-day cash conversion cycle.
607 days, that's unbelievable. To put that in perspective for listeners, what would a normal industrial company aim for?
A stable, mature manufacturer might target maybe 90 to 120 days. So 607 days means they're waiting almost 2 years on average from when they pay for raw materials to when they get paid by the customer.
And what's driving that?
It's driven by a massive strategic inventory buildup over 19,962 lakhs worth. They have to secure materials years in advance to service these long-cycle A&D programs.
And that cash drain has to show up somewhere on the financial statements.
It does, very clearly. This creates what the report calls a financial leakage. The forensic scorecard flags the CFO to EBITDA ratio at a very concerning negative 120%.
Wow.
And free cash flow is also negative at over 6,300 lakhs in FY25. The inventory is just choking their cash flow for now. But again, management sees this as a necessary evil to execute on these huge contracts.
So beyond the cash flow risk, there are also pretty big concentration risks, which could be a real problem if the geopolitical landscape shifts.
Absolutely. First, geographically, about 80% of their revenue comes from the USA. Any big shift in U.S. defense spending or a new tariff regime could hit them very hard.
And second, client concentration. Boeing alone is 30 to 35% of their revenue.
Correct. The analyst estimates that a major geopolitical event or trade tariffs could trigger a 700 basis point margin hit. You combine that with the compression they're already experiencing, and that would be extremely painful.
With risks that high, you'd really want to see strong management and governance to feel confident. What does the report say on that front?
On that front, the context is excellent. The forensic scorecard, which is a crucial metric when there's financial strain, comes in at 93.25, which is rated excellent quality.
That's reassuring.
Very. And it's supported by 0% promoter pledging and no outstanding actions from regulators. It suggests the management team is transparent and clean, which is vital when you're navigating a 607-day cash cycle.
And management's own commentary backs up this whole story. The MD, Rishabh Gupta, is quoted saying they expect costs to normalize over a short period of time as they get through these FAI cycles. So they seem very confident this is a temporary state. Okay, let's pivot to valuation, because this is what really stands out. The stock trades at a PE ratio of 113. The industry average is 48. That's 135% higher. I mean, that sounds like a massive hike valuation. How on earth does the analyst justify that?
This really is the crux of the whole thesis, the scarcity premium. And while 113x seems incredibly rich, the justification is actually pretty sound. It's based on their niche.
So it's not a direct comparison to other players.
You can't really compare them. You look at a peer like HAL, trading around 40x PE. HAL builds entire systems, like the Techsys fighter jet. Rossell is a Tier-1 EWIS specialist. They own a critical, indispensable piece of the puzzle, and they are the only pure-play A&D compounder in India with this level of certification.
So they get that premium because there's no one else quite like them.
Precisely. And their return on capital employed is a healthy 20%, which is above the industry average. The premium valuation is basically pricing in the belief that this 3% net margin is a temporary trough before a huge expansion once the space and semicon businesses mature.
The analyst wraps it up with a fantastic analogy. They describe Rossell as a digital and mechanical toll bridge in the aerospace supply chain. Let's talk about what that really means.
Yeah, that analogy works really well. A toll bridge means you're integrated at the foundational level. You control a critical pathway. They get paid whether an F-18 goes to the U.S. Navy or gets sold to an ally like Australia.
Right. They collect a toll on every single unit that passes through.
On every single unit produced globally that uses their systems. Their move into semiconductors and space is just them building more toll bridges into new high-tech highways.
So if you're watching this company hoping this big bet pays off, what are the key things you should be monitoring over the next few quarters?
The report lays out 4 key monitorables. First, watch for the successful commissioning of their new 150,000 square foot expansion in the second half of FY26. They need that capacity.
Okay, number 2.
Second, look for the T-7 Red Hawk jet program to scale up in FY27. That'll be a huge sign that they can move from the painful FAI stage to large-scale production.
And third is the big one, I assume.
The most crucial one, hitting that strategic target of 40% revenue share from semiconductor and space by FY27. If they hit that, it proves the whole painful pivot was worth it.
And finally, that huge inventory problem.
Right. Watch that inventory. Management's goal is a 90-day cycle. If you see that 607-day cash conversion cycle start moving meaningfully toward 90 days, that's the signal that the financial pressure is easing.
So what's the final recommendation?
The recommendation is hold or accumulate on weakness. The fair value is set between 700 and 750, which projects a reasonable 12 to 19% upside as that operational leverage from the new sectors finally kicks in.
So putting it all together, the conclusion is Rossell is in the middle of a very calculated maneuver. They are sacrificing short-term profit, taking on huge costs, all to build an indispensable foothold in these high-margin sectors.
They're betting their toll bridge status will pay off massively once this learning curve is over and they can operate at scale.
It's a bold strategy.
It is. Which leads to our final provocative thought for you. Given that their entire competitive advantage hinges on those 45 NADCAP processes and other high-entry modes, how quickly could a domestic competitor, or maybe a rival in an allied nation, actually replicate enough of those audited processes to truly challenge Rossell's indispensability in, say, the next 5 years?
Thanks for tuning in. Remember, this isn't financial advice, and since we utilize AI, always verify the data yourself. See you next time. Welcome to Analyst's Estimate.